This hearing is entitled Banking the Unbanked, Exploring Private and Public Efforts to Expand Access to the Financial System. I now recognize myself for 4 minutes to give an opening statement. At the start of the pandemic, a constituent of mine reached out to my office. We can call her Mrs. McGillicuddy. Mrs. McGillicuddy did not have a bank account, so she received her Social Security benefits in the form of a direct express debit card. After the CARES Act passed, the first wave of economic impact payments went to Americans with a bank account on file with the IRS. So Mrs. McGillicuddy had to wait. When she finally did receive the paper check, Mrs. McGillicuddy was forced to find a check cashing service where, for a fee, she could cash the check. Compare that with the experience of folks who had an account linked to the IRS. They got the payments first and for free. One recent report estimates the CARES Act economic impact payment recipients spent $66 million just to cash the first round of checks. According to an FDIC survey, the number one reason why Americans didn't have bank accounts was because they didn't have enough money to meet a bank account's minimum requirement. This is one example of how expensive it is to be poor in the richest country in the world. As of 2019, 1 in 5 Americans was unbanked or underbanked. 5.4%, or about 18 million Americans, do not have access to a bank account at all. An additional 16%, or about 53 million Americans, have access to a bank account, but also rely on alternative financial services such as money orders, check cashing, payday loans, or other services in place of traditional banking. There is also a significant racial disparity in access to banking services. Latino households are more than twice as likely to be unbanked or underbanked, and African American households are more than 3 times as likely to lack access to traditional banking services compared to white households. For the country with the most powerful economy in the world, these statistics are unacceptable. However, I will also note this data was gathered before the pandemic and sharp rise in unemployment. Historically, unbanked and underbanked rates are correlated to unemployment, so the true numbers may be worse. If we want the economic recovery to be inclusive and reach every community, we need to make sure people stop being penalized for not being born on third base. Today's hearing will examine trends in unbanked and underbanked households, challenges to improving access to banking services, and proposals to expand the availability of safe and affordable financial services for everyone in every community. Ensuring every American has access to a safe and affordable bank account will make our economy stronger, protect vulnerable consumers, and make our nation better prepared to confront a national emergency. With that, I'd like to now recognize the ranking member, Mr. Luke DeMeyer from Missouri, for 4 minutes for his opening statement.
Thank you, Mr. Chairman, and thank you for having this hearing today. I'd also like to thank the witnesses for being here today and agreeing to testify. The topic we're discussing today is extremely important. Getting more people into the banking system can have a drastic impact on their lives. Not only do banks provide a safe and protected way to store money, but banking services generally provide consumers with cheaper financial services than other businesses involved in finance. For example, most banks offer free checking accounts, check cashing, and deposits. Many offer wire transfers at a cheap flat rate, and most allow cash withdrawals at your financial institution for free. Not only are these day-to-day services critical, but having an existing account at a financial institution can assist in accessing credit for both consumers and businesses. Look no further than the pandemic, where we saw financial institutions participating in the Paycheck Protection Program. In addition, individuals with a bank account found it much easier to get their economic impact payment from the IRS. I'm sure all the members here today have dealt with constituents without a bank account who are still struggling to get this money from the IRS. Since 2009, the FDIC has surveyed and examined how American households are using banking services. The latest survey from 2019 shows the lowest estimate of unbanked households since the survey started. And in fact, the household unbanked rate has consistently fallen since 2011. This progress means that 3.7 million households in the United States have joined or rejoined the banking system since 2011. an accomplishment that could be celebrated, at the same time examined to ensure progress is maintained. So what has worked and what has not worked in driving down the unbanked rate? It is clear the progress made since 2011 happened without a government takeover of the financial system. 3.7 million households joined the banking system without the Federal Reserve offering checking accounts, without the post office acting as a financial institution, and certainly without CFPB taking over the credit reporting industry. According to the FDIC, the single biggest factor that lowered the unbanked rate was improvement in the socioeconomic circumstances of the household. Put simply, the pro-growth policies of the Trump administration led to improved circumstances for all Americans and, according to the FDIC, drove 2.4 million households into the banking system. There are also many non-economic factors to consider when discussing the unbanked population. For example, 16% of unbanked households listed not trusting banks as their main reason for not having a bank account. In addition, among unbanked households, 56% were not at all interested in even having a bank account. Despite these difficulties, financial institutions and stakeholders are looking at ways for private industry to bridge the unbanked gap in this country. The FDIC recently started Get Banked, a public awareness campaign to inform and inspire consumers to join the banking system. Furthermore, the CFE Fund has partnered with financial institutions around the country in the Bank On initiative, which lowers low-cost accounts for for consumers. Raising awareness and increasing innovation will be critical to lowering the unbanked and underbanked gap in this country. Congress should be looking to support new ways to provide traditional banking services that reach the unbanked population, to provide regulatory clarity for new technologies in the marketplace, providing financial access, and lastly, should not get the government involved in providing banking services to consumers. Look forward to the discussion of these topics with the witnesses today. With that, Mr. Chairman, I yield back.
Thank you, Mr. Luetkemeyer. The chair now recognizes the chairwoman of the full committee, the gentlewoman from California, Ms. Waters, for 1 minute.
Thank you, Chair Perlmutter. I'm pleased that this hearing focuses on access to banking services, especially for communities in banking deserts. Without a nearby branch to go to in the Los Angeles area, the rate of unbanked households is higher than the national rate, and the unbanked are disproportionately lower income households of color. Having access to a bank account is fundamental to financial security. Millions of Americans who did not have a bank account during this pandemic had to wait weeks or months to receive stimulus checks while they struggled to afford housing, to take care of their loved ones and otherwise make ends meet. The Wall Street mega banks have mistreated unbanked individuals for long enough. Our constituents in California, Colorado, and New York, and across the country are fed up and are advocating new consumer-centered solutions such as no-fee Fed accounts and public banking. I look forward to the testimony from our witnesses, and I yield back the balance of my time.
Gentlelady yields back. I'd now like to recognize the ranking member of the full committee, the gentleman from North Carolina, Mr. McHenry, for 1 minute.
Thank you, Mr. Chair. Today's hearing is another example of Democrats using the financial system to score points with progressive activists. We're talking about a very important issue, but the bills attached to this hearing are much more of a partisan wish list than they are about the substance of driving financial inclusion. Look at the politically motivated move last month to take down the True Lender bill. That makes things less clear, less certain about bank and fintech partnerships. We know that Democrats want to drive a government-centric, government-run financial system. It's a one-size-fits-all approach, which will not drive financial inclusion. I can tell you this, the federal government is not innovative. It's not nimble, and it will not increase financial inclusion. We can drive financial inclusion with banks and fintechs working together, provide consumers and small businesses with greater access to affordable financial products and services, especially those in underserved and rural areas. It's innovation, not a government cudgel, that will drive financial inclusion. That should be the subject of today's hearing, not the list of bills attached to this hearing. Yield back.
Gentleman yields back. I'm now pleased to welcome each of our witnesses. We have 5 excellent witnesses today, and I want to introduce our panel. We have first Ms. Marisa Baradaran. She is a professor of law with the University of California, Irvine. Professor Baradaran's focus includes financial inclusion, inequality, and the racial wealth gap. We then have Ms. Dayanira Del Rio, who is the co-director of the New Economy Project. Ms. Del Rio has worked for more than 20 years on cooperative finance, immigrants' economic rights, and equitable neighborhood development. We then have, both are virtually attending today's hearing. Thank you very much. In the committee room, we have Mr. Amaya Pawar is a senior fellow at the Economic Security Project. Mr. Pawar is a former alderman of Chicago's 47th Ward and is working on efforts around guaranteed income and public options in financial services. We have Mr. David Rothstein is a senior principal with the Cities for Financial Empowerment Fund. Mr. Rothstein leads the CFE Fund's work on the Bank On initiative through account certification and coordination among stakeholders. Finally, we have Mr. John Burlaw, who is a senior fellow with the Competitive Enterprise Institute. Mr. Burlaw focuses on public policy affecting access to capital, entrepreneurship, and investments, and he is also a contributing writer for Forbes. Thank you all for being present today. You are reminded your oral testimony will be limited to 5 minutes. You should be able to see a timer on the desk or on the screen that will indicate how much time you have left. When you have 1 minute remaining, a yellow light will appear, and I'd ask you to be mindful of the timer, and when the red light appears, to wrap up your testimony so we can be respectful of both the other witnesses and the committee members' time. Without objection, your statements will be made part of the record. So we'd like to begin with Professor Baradaran. You are now recognized for 5 minutes for your testimony.
Thank you so much, Chair Perlmutter and Ranking Member Luetkemeyer, members of the subcommittee. Thank you for this opportunity to testify on this very important issue. The burdens and costs faced by millions of Americans excluded from the nation's banking system are not new, but the stakes have gotten higher over the last decades as digital banking has become essential to full participation in the economy. The recent COVID crisis further exposed the inequalities embedded in the nation's credit and payment system and revealed the urgency for reform. Just a few recent examples. When Congress acted decisively on behalf of Americans to send the first and second rounds of COVID relief to struggling households, many unbanked and underbanked Americans, the population most in need of help, either did not receive payments, had to pay fees to collect from ATMs or tax preparers, and many stood in long lines exposing themselves to the virus. Just recently, and that is to lower ATM fees. Just recently, as Congress and the administration acted once again to send child tax credits, reports estimate that about 1 in 5 of families whose accounts are not linked to the IRS database will have to jump through hoops to get these checks or pay fees or never get the checks at all. This takes time, stress, and a lot of money. And it's been a blockbuster year for banks, and they've collected over $31 billion in revenue from fees alone. And remember that the Americans living on the thinnest of margins pay the majority, the bulk of these fees. 1 out of 11 Americans spent $350 or more a year in overdraft fees. And that's a lot of money for families living on the margins. Overdraft is one of the many reasons why it is expensive to be poor in America. In fact, Black communities, Native American communities, rural communities, and the elderly, those already living on the margins who pay the most because they lack access to the nation's payment system. This is not a problem of technology, it's a problem of policy. In fact, I want to propose that we need not get bogged down in complexity. The problem is straightforward, and I believe the solution is also simple, which is usually not the case with policy. The problem is this: the US payment system is only available to banks and their customers. If you're outside of it, you have to pay a toll to use it. I urge Congress to open up these tracks on which our nation's commerce runs to everybody. Congress need not reinvent the wheel. Congress already created a public payment system, the Federal Reserve. The Fed's explicit charter is to serve the public interest and to increase the integrity, efficiency, and equity of the US payment system. That was a mandate Congress gave it. I urge Congress to ensure that everyone have equal access to this vital public utility. I believe that the most effective way to do this is through a partnership between the Treasury, the Federal Reserve, and the postal banking system. The Treasury already maintains a relationship with Americans through the IRS and the benefits infrastructure. Instead of using a middleman to send checks, it can route those payments through the post office, whose budget is actually linked to the post office, and who the post office has historically been a bank in America and abroad. On the consumer side, what this would look like is you would go to your local post office, deposit your money, take cash out of the ATM without fees. You could set up automatic bill pay through online or mobile banking, get a debit card to use when you're out shopping or online, and then link up to a digital account or fintech app. In fact, across the world, postal banking banks more people than the fintech industry or private banks. And crucially, it allows many of those people to connect to others digitally. Digital banking is essential to modern commerce, but to truly reach the unbanked and underbanked, you need a physical location, the ability to deposit your cash wages and take out cash to pay for goods. This is the first crucial step to financial inclusion. This is because between 20 and 40 million Americans don't have broadband internet access. Many Americans do not have mobile devices or computers, including elderly Americans. Two, most LMI communities still operate at least some portion of their financial activities in cash. They receive wages in cash or have to use cash to buy groceries or fresh fruit or babysitters or rent. Research shows that for the vast majority of Americans with an income of less than $50,000, they prefer just a simple debit card and don't have that. Why aren't banks serving these consumers? Over the past 10 years, as banks have become bigger and more profitable, 93% of their bank branch closings were in LMI communities. Rural Americans have lost over half of their banks. Banks don't serve these communities for the simple reason that there aren't enough profits. So we can either try to keep coaxing the industry through carrots and sticks, or simply offer services directly through public banks. In fact, as banks have deserted many of these low-profit zip codes, the post office has remained in accordance with its public mission. The post office, with over 33,000 branches, most of their branches are in LMI communities, and Americans know it. Recent survey shows that the post office is actually #1 in America's most trusted brand to do what is right. And this is because the post office, accordance with what President George Washington inscribed in law in 1792, has a very public serving mission. In conclusion, it's already a public institution. It has a legacy of being a public bank in the US, and it can do so again, making the lives of many Americans a little easier and less expensive. Thank you. Sorry for going over.
Thank you, Professor. Now I'd like to recognize Ms. Del Rio for her testimony for 5 minutes.
Thank you. Good morning, Subcommittee Chairman Perlmutter, Ranking Member Luetkemeyer, and members of the subcommittee, as well as Committee Chair Waters. Thank you so much for the opportunity to testify today on behalf of New Economy Project, an economic justice organization based in New York City. For 26 years, our organization has worked with community-based organizations and low-income New Yorkers to combat persistent redlining, predatory lending, and other inequities in our financial system and economy that serve to perpetuate racial wealth inequality, neighborhood segregation, and poverty. We work with community groups now to advance public banking, strengthen community development financial institutions, and to undertake other strategies that democratize control over finance, land, housing, and other sectors of our economy. My comments today are also informed by my role as board chair of the Lower East Side People's Federal Credit Union, which is a U.S. Treasury certified community development financial institution, or CDFI, that has 35 years of experience serving historically redlined communities across New York City. My testimony today will address ways in which our current financial system serves to extract rather than build wealth, and the need to strengthen and enforce laws to hold banks and other financial institutions accountable to people and communities. At the same time, we must focus on creating public banks and other institutions and infrastructure that can build community wealth and serve the public interest. First, I want to say that underscoring what you've heard already, barriers to banking access that this subcommittee is addressing in today's hearing are longstanding and systemic in nature. They therefore call for bold and systemic solutions. Congress and the federal banking regulators can and should take comprehensive action to address persistent redlining, discriminatory identification policies, predatory overdraft fees, and other barriers that block or actively drive the working poor and people of color out of our banking system. At the same time, we must combat the notion that financial innovation, or financial products, and credit in particular are solutions to entrenched poverty and inequality. To give you one example, we have across the country in many states 400% APR payday loans that extract wealth from working poor families. Their solution, the antidote to these usurious loans, is not to develop less predatory short-term loans, but rather to ensure access to living wage jobs, truly affordable housing, strengthen safety nets, and other measures that address root causes of economic insecurity. And finally, we need fundamental change in new institutions to create a financial system and economy that work for all. I'm especially pleased to share our organization's work in New York City and state to advance local public banks, which we see as critical to fostering strong local economies and a just recovery. Public banking is common throughout the world and on the rise across the US. Public banks are financial institutions owned by public entities like a city or county that hold public deposits and are chartered to serve the public good rather than the interests of private profit-seeking shareholders. Through public banking, local governments like ours in New York City can build on what's working in our financial system, partnering with CDFIs and other community-based lenders to expand fair banking access and to deepen investment in affordable housing, small businesses, renewable energy, and other critical infrastructure. Public banks also allow local governments to control their money, our public money, and to move it out of banks that engage in redlining and predatory financial practices, and that finance fossil fuel extraction, real estate speculation and displacement, and other activities that harm local communities and run counter to our public policy goals. New Economy Project is coordinating 2 broad-based coalitions in New York to advance public banking. We are advocating for passage of state legislation, the New York Public Banking Act, that would create a safe and appropriate regulatory framework for cities, counties, and regions that want to establish public banks. The legislation has gained massive traction with 65 legislative co-sponsors and broad-based support from more than 100 community and labor organizations and New York-based CDFIs and responsible lenders. The Federal Public Banking Act would be a game changer to local endeavors like ours by providing technical assistance and grants to support the formation of mission-driven public banks, to give local public banks access to the Federal Reserve's payment systems and create other frameworks of support. Public banking would serve as an especially powerful tool as cities and states throughout our country work to advance a just recovery from our pandemic and to withstand future crises. We've seen that countries that have public banks are significantly more resilient in the face of crises than those without them. And that's precisely because local public banks invest in sectors that provide direct economic, social, and environmental benefits. And in the context of the growing and interrelated crises we face, health, housing, racial inequality, and climate crises, the federal government, we believe, must take bold action to support these efforts and transform our communities. Thank you again for the opportunity to testify.
Thank you, Ms. Del Rio. Mr. Pawar, you're recognized now for 5 minutes.
Thank you, Chair Perlmutter, Ranking Member Lukemeyer, and members of this subcommittee. My name is Ameya Pawar, and I'm a fellow with the Economic Security Project and the Open Society Foundations, where I work on guaranteed income and public banking policy. These are both issues that were very different just a few years ago when I started working on them when I was on the City Council in Chicago, but have converged over the last 18 months as a result of the global coronavirus pandemic. I'll get to that in just a moment. It's an honor to be here, and I'm here to express my support for Fed accounts and public banking. Not one or the other, but both. And the reason why is that they are both market-based solutions to solve widespread financial exclusion. At a very base level, every person, every small business needs a bank account to receive money, to deposit earnings, to save, to pay bills, and to be able to do so without paying exorbitant fees or extraction. And then people and small businesses need access to wealth-creating loans, home and business loans. These loans are the foundation of economic development in this country. Loans that banks make banks sort of a public policy maker. when they decide who gets money, who gets loans, and who doesn't. And today, we have widespread economic exclusion where 25% of Americans are unbanked or underbanked, and they are paying up to 10% of their incomes annually to access basic financial services. So what we have is a system that the more money you make, the cheaper it is to manage your money. The less money you make, the more expensive it is to manage your money. And the more money you make, the cheaper it is for you to take out loans and create additional wealth. The less money you make, you're prohibited from taking out those wealth-creating loans. And so Fed accounts would bring millions of people into the banking system that currently are excluded. It would restore trust in the system and make it possible for them to carry out their financial affairs. Then on the other hand, the Public Banking Act is transformational because it allows counties, cities, and states to set up public banks that can channel capital to small businesses, that could originate micro mortgages and loans for first-time home buyers. It could finance new public options for housing, childcare, and broadband, all of which are market-based additions to the existing economy, all of which are necessary as part of a healthy market. I started working on both of these issues when I was coming to an end of my second term in the city council. When I first got there 10 years ago, I thought the best way to combat inequality and poverty was to pass legislation and reform government programs. So I worked on efforts with my colleagues to raise the city's minimum wage, guarantee paid sick leave, combat wage theft. I worked on reforms on tax increment financing. I worked on opportunity zones. I interfaced with philanthropy and other government grants. And what I found was that all of this work just worked on the margins. It wasn't enough to drive economic development in communities. It was necessary and critical work to lift wages. But if you don't have access, but if you raise your wages and it costs you money to cash your paycheck, if it costs you money to pay your bills, if you don't have a bank account to save, and you have no access to wealth-creating loans, you're basically giving people a weighted life jacket. And to me, in my mind, that is why what we need is basic bank accounts and access to wealth-creating loans. And that's why both of these pieces of legislation are important. And the other thing I might add is that banks, when they choose to serve a community or choose to deny a community, that is an act of public policy. You see, when banks systematically lend within a community to homeowners and businesses, that broadens the tax base, that increases property values, that increases property tax revenues. And when you do that systematically over and over again, more people buy homes, more people open businesses, and that creates a healthy economy. When you deny communities that, we all have driven through communities that are littered with payday loan centers and currency exchanges and tax prep centers. There's also communities where you see less tax revenue, lower property values, and so on and so forth. So when banks decide to choose to serve a community, they are exercising public policy. And I just think it's worth asking ourselves, should this much policy-making power be concentrated in the hands of a few, or should we create a healthy market with public options such that everyone has access to a bank account and wealth-creating loans to drive economic development? Thank you.
Thank you, Mr. Pawar. Now I'd like to recognize Mr. Rothstein for 5 minutes for his testimony.
Thank you, Mr. Chairman Perlmutter, Ranking Member Lukemire, Vice Chair Kostoff, and members of the Subcommittee on Consumer Protection in Financial Institutions. My name is David Rothstein. I'm a senior principal with the Cities for Financial Empowerment Fund, known as the CFE Fund, where I lead the National Bank On initiative. The CFE Fund's mission is to work with municipal and other partners to provide financial empowerment programs and services on a large scale, and our work spans across more than 100 city, county, and even state governments. Our Bank On program harmonizes financial institutions of all sizes and types, local government, nonprofit partners, and consumer advocates together through a national product certification program with the goal of bringing and underbanked households into safe, affordable, and fully transactional bank and credit union accounts. On behalf of the more than 100 financial institutions with certified Bank On accounts and our 90-plus coalitions around the country, I'm honored to testify you today about how Bank On is here to meet the moment you are so admirably prioritizing here. Bank On is a success on a number of measurable levels. 8 years ago, we established the first ever national account standards with close consultation of regulators like the FDIC, advocates, financial institutions themselves, local elected officials, and community organizations. These standards directly address principal concerns like overdraft and insufficient fund fees. We started with the 4 largest banks in the country having certified products, but have quickly grown to 110 banks and credit unions. In fact, certified accounts can now be found in 40% of all the branches in the United States. Banks offering a Bank On certified account represent more than 51% of the deposit market share, according to the FDIC. And more than 24 of these accounts can be opened online by new customers, further expanding that access to rural and urban neighborhoods that don't have branches in their communities. The market for Bank On accounts is thriving. Led by our partners at the Federal Reserve Bank of St. Louis, the Bank On National Data Hub finds that these accounts are extremely popular and the market is really robust. In 2019, nearly 2 million Bank On certified accounts were opened in that year alone. We also know that more than 85% of new account openings were completely new clients to the financial institution, a strong proxy for banking access. We know that Bank On is helping the unbanked in the hardest to reach markets. The FDIC finds that households of color are 5 times more likely than white households to have a bank account. A recent analysis by the Bank Policy Institute found that more than 60% of Bank On accounts opened were in neighborhoods with more than 50% minority population. The widespread availability of Bank On certified accounts is, of course, only part of the banking access equation. It's connecting people to these accounts that makes the difference. The Bank On equation looks for ways to integrate banking access into large-scale funding streams, and our 90 Bank On coalition partners help make that happen in their communities. Almost 24 cities, for example, incorporate Bank On account opening into summer youth employment programs, and the ability to rely upon the national account standards assures those government leaders that these are the right accounts and that they are safe. Led in partnership by our Bank On Maryland coalition, the state of Maryland now facilitates Bank On account opening for unemployment benefits. And now the Treasury Department and the IRS have been facilitating Bank On account opening in partnership with the robust efforts of the FDIC, with facilitating account opening as a way to get both the economic impact payments and now the advanced child tax credit payments as well. All this is here to say that while we are thrilled that policymakers and agencies are interested in widespread banking access, Bank On is demonstrating today, right now, both that you can get institutions to offer the right accounts that people will open, and people will open them by the millions each year. Why create a separate but equal system that will be incredibly complex and take years to produce? Why ignore this very tangible solution rather than amplify it? Thank you for your time, and I'm more than happy to answer any questions that the committee has going forward. Thank you again.
Thank you, Mr. Rothstein. Mr. Berla, you now are recognized for 5 minutes.
Chairman Perlmutter, Ranking Member Luetkemeyer, and honorable members and honorable guests of this subcommittee, thank you for this opportunity to present testimony on behalf of my organization, the Competitive Enterprise Institute, at this hearing on the vital topic of financial inclusion. CEI is a Washington-based free market public policy organization founded in 1984 that studies the effects of regulations on job growth and economic well-being. At CEI, we have championed private sector innovation that promotes financial inclusion and warned about government red tape that contributes to the problem of the unbanked. We sounded the alarm about Dodd-Frank Section 1075, also known as the Durbin Amendment interchange fee cap, that transferred through price controls much of the cost of the processing of debit cards from retailers, including very large retail chains, to some of the nation's poorest consumers. We pointed out that largely as a result of this measure, the percentage of free non-interest checking accounts, which were 76% in 2009, went to just 39% in 2012. And a George Mason University professor's study that found that may have resulted in more than 1 million being unbanked. In the last few years, there has been progress in more Americans being part of the banking system, but there is still much more further to go. The good news is that both fintech firms and community banks and credit unions are producing remarkable innovations. The government has a role in ensuring clear disclosure and swift punishment of fraud, but should otherwise refrain from either heavy-handed regulation or the creation of state-owned financial service entities that could smother and crowd out this innovation. Of the bills being discussed today, I can say I support the approach of the Expanding Financial Access for Underserved Communities Act that lifts regulatory barriers to individual credit unions that decide it would make good business sense to add underserved customers based on their mission of service. But while the credit union bill is a bottom-up approach to financial inclusion, the other two offerings are top-down approaches that would worsen the lot of the unbanked, as well as many other American consumers of the financial system. The access to no-fee accounts is a version of what has been called Fed accounts, in which the Federal Reserve would directly compete with banks and credit unions to provide deposit accounts to consumers. This approach raises a host of problems involving privacy, data security, crowding out private sector innovation, and depriving banks and credit unions of deposits necessary to make loans. The approach of the Public Banking Act of 2021 raises similar concerns to Fed account, plus has some uniquely troubling aspects of its own, such as risk to the taxpayers who would provide basically federal guarantees to government, state-owned banks of various jurisdictions. But perhaps the biggest concern of this particular bill is that financial exclusion rather than inclusion of a legal industry is one of its stated goals. The bill prohibits banks with its charter from providing loans to, making investments in, and basically providing any financial services incidental to a fossil fuel project. Now, ironically, the state-owned Bank of North Dakota, which has been touted as an example by some witnesses, would be disqualified as a covered bank under this bill because it provides financing for drilling and fracking in the oil-rich regions of the state. My colleagues and I have been consistent in saying that government officials should not use the banking industry to launch indirect attacks on industries they disfavor. We support the Safe Banking Act, sponsored by Chairman Perlmutter, to prevent the federal government from punishing banks and credit unions that deal with marijuana business in states where it's illegal. And we applaud Ranking Member Luetkemeier's efforts to uncover and then end Operation Choke Points, in which various federal agencies push banks to cut off businesses ranging from guns to small dollar lenders. CEI believes that in all transactions involving controversial but legal industries, individual financial firms should be allowed to make their own assessments of reputational risks. And we also believe a competitive market free of heavy-handed regulation and state-backed entities that would suppress innovation and do other harms is one where all types of entrepreneurs create products and services for all types of consumers, enabling a financial system and an economy that is both dynamic and inclusive. Thank you for inviting me to testify. I look forward to your questions.
Thank you very much, Mr. Berla. I'll recognize myself for 5 minutes of questions. And Mr. Rothstein, I want to start with you. Based on some comments Mr. Pawar made, Ms. Del Rio, Professor Baradaran, about how expensive it is to be poor in America with overdraft fees and high interest rates and just fees generally. And, you know, nobody even talked about parking tickets. If, you know, you add up all these things, it's tough for people who don't have much in the way of resources. So you stated that more than 100 financial institutions now offer bank-on certified accounts, but that's only a small fraction of the total number of depository institutions in the country. What obstacles, what obstacles do financial institutions face in offering bank-on certified accounts, and what is CFE Fund's strategy for continuing its expansion of the program?
Thank you for that. Thank you for that question, Mr. Chairman. The first thing I would say is that the growth is very fast-paced. So back in October, slightly November, we were at about 50 banks and credit unions offering accounts. And so here we are with more than 100 currently offering them. And those, as I mentioned, those financial institutions make up about 40% of the branches in this country. So it is a significant part of the banking infrastructure that have accounts available. I think what the obstacles used to be, and what we've really worked hard on, are the first thing is to make sure that there was one ask of financial institutions when it came to checking accounts. I think early on there were multiple asks by many different partners, whether it was government officials or community groups, and so the Bank On ask is one ask, right? It's one account. They can obviously have other accounts in their suite of accounts, but the Bank On account is one very specific checking account that's fully functional. The other piece was that there were resource issues too. I think financial institutions thought that creating this type of account would be challenging and hard, especially some of the smaller financial institutions. The partnerships with the American Bankers Association, as well as the largest core processors in the country, have provided resources and help for financial institutions to create these accounts. And so those partnerships, in addition to the partnerships with regulators like the FDIC, who's provided advice on language changes, compliance issues, have been really helpful to the financial institutions.
So do the banks or the credit unions, anybody who's offering a Bank On account, do they get any credit with the Community Reinvestment Act, or what incentives might also be there to provide these kinds of accounts?
Yeah, that's a great question. Thank you, Mr. Chairman. So the first is, we do know that banks are getting CRA credit for these accounts. Certainly one improvement, and we did submit comments to the recent request for comments on CRA, would be to have a more established prominent role for receiving CRA credits for offering Bank On accounts. For obvious reasons, CRA focuses a good bit on lending, but we absolutely believe that bank accounts matter, and so that would be a big part of this.
Mr. Pawar, 83% of banked respondents reported visiting a bank branch in person in 2019. In your testimony, you describe how Chicago has lost a significant number of bank branches over the last decade. And can you describe the importance of a physical bank branch location and their impact on lending and serving hard-to-reach communities?
Thank you for that question, Chairman. So there are two problems connected with this. One, in Chicago, we've lost over 200 bank branches in the city, primarily in lower income and communities of color. So there's the physical access to a branch that is incredibly important. And then there are lots of communities in Chicago and around the country that have banks, but the banks just don't serve the community that they reside in. And so we have two problems really to solve, which is one, we need banks to be able to serve people, and then we need those banks to extend wealth creating loans. The elegance of Fed accounts is this. It uses existing community banks as the conduit to extend those accounts. In other words, the Federal Reserve would hold these dollars, but the local community banks would be the conduit for those accounts. So this isn't a replacement of community or private banks. It is really in addition to the market. The other piece that is critical is that there are 21 million people who live in census tracts that do not have a single bank or credit union. And that is where the post office can fit in and be the conduit for Fed accounts.
All right, thank you. My time has expired. I'd like to now recognize Mr. Luetkemeyer, the ranking member of the committee, for his 5 minutes.
Thank you, Mr. Chairman. Mr. Below, your testimony caught my eye here with regards to you believe that the Truth in Lending Act needs to eliminate the use of APR for loans under a year in length. I've been talking about this for a long time. These short-term loans, APR is not reflective of what the real cost is of that loan, and therefore it's really deceiving to the customer when they come in about what this. Would you like to elaborate on it just a second?
Yes, thank you for that question. The great economist Thomas Sowell has said that if we measured the cost of hotels the way we did the cost of short-term loans, then a $100 night hotel room would be priced at $36,000 because that's how much it would cost if you stayed there 365 days or 360 days of the year. So I think it's really not appropriate for, like, say, a loan that is taken out for 2 weeks or a month where the interest rate may be 30% suddenly becomes 390% when you measure it according to APR.
Very good. Thank you for that. Mr. Pawar, according to the Cambridge Dictionary, the term market-based is defined as organized so that companies' prices and production are controlled naturally by the supply and demand for goods and services rather than the government. You made a statement that public banking is based on market-based solutions. With this definition, explain what you just said there. How does that fit in that definition, allowing the production and to be controlled naturally by supply and demand?
Thank you for that question. That definition doesn't exclude the fact that a publicly owned enterprise couldn't be a part of the market. For example, one of the most.
No, you said that it was, and I quote, public banking is based on market-based solutions. Market-based solutions to banking is what public banking is. Have you ever been in a bank? Have you ever worked for a bank?
I have not.
Have not. Have you ever been a small business owner or a business owner at all?
No.
No. So you've been in the private, or you've been in the academic world your entire life, or think tank world?
And I also served 2 terms in the city council in Chicago.
Okay. So it's really interesting whenever you believe, it said here that loans are public policy. If you ever worked in a bank or understand how banking operates, sir, you would know that if the bank is not investing in its community, it's not going to grow. The bankers want their communities to grow. They want to invest in the communities. They want to make loans to the communities. The loans they don't make are ones where they don't believe the risk is worth the reward. The risk is worth putting their own assets at risk for whatever they want to make the loan for here. So loans are not necessarily public policy. Loans are how you grow your community and grow the bank and the whole economy around you. Your misconception of what goes on in the banking industry is breathtaking for what you're trying to do here today. Ms. Baharadharan, you talked about postal banking, and you made the comment about hard for banks to exist in rural areas because of low profit. Do you understand that post offices in rural America make no money? They lose thousands and thousands of dollars?
Yes, sir. But as George Washington, and Benjamin Franklin set up the post office, it cross-subsidizes. So the more profitable post offices
you missed
are.
My point here. You missed my point. Your point was it's difficult for banks to exist in rural areas because the amount of business is not necessarily enough to pay the bills. I can tell you, I live in a town of 336 people. My post office got half of its service cut off. We're down to half days now. And I can tell you that looking at the cost of each one of the rural post offices in my district, they lose money between $50,000 and $250,000 a year. $50,000 and $250,000 a year. So when you talk about having the post office be able to provide services that are going to be wonderful for people, you're going to add to the deficit of their ability to do business and cost our country money.
I see this as a way to help.
It's breathtaking, the lack of knowledge of how, when you start talking about these issues, how the real world operates. And it's very disappointing and very, very unfortunate. Mr. Chairman, I see my time's expired. With that, I yield back.
Gentleman yields back. The gentleman from Georgia, Mr. Scott, the chairman of the Agriculture Committee, is now recognized for 5 minutes.
Thank you very much, Chairman Perlmutter. This is a very timely and very important hearing. I've been on this committee during my entire 19 years in Congress, and I've been working on this issue of financial inclusion. And we're making some progress as we move. But we got a tremendous problem. Many people don't know that out of our 50 states, their school systems, only 17 of those states offer a single course in financial education at their schools. We're way behind. I managed to get a bill passed, and 2 months ago, our Financial Inclusion Act. So we're making progress. But now here we're faced with a real live wire situation. And that is this. We in Congress and the Biden administration, Democrats and Republicans, we passed a bill that requires monthly payments for the child tax credit to 48 million families. Now, ladies and gentlemen, let me share with you how stark this problem is before us, okay? We got this child tax credit going out to 48 million families in this country. However, today, 14% of these Black families, 12% of Latino families, and 2% of white families. Now, that comes to a total of 28%. So we got a child tax credit going out there to these people, millions of which don't have a bank account. And they're subject to the predators, cash checkers, payday lenders. And we've got to find a way to get these individuals with a bank account. We got a massive education. So let me just ask you, Mr. Varadaran, I hope
Yes.
I got it
Perfect.
right.
Perfect.
Okay. What proposals, tell us, should Congress be considering to ensure that our Black families, our Latino families, our white families, and many of these in rural areas don't have it? They're not even connected to the internet, but we got a bill through my House Ag Committee to connect. But you see, we got these things in motion. So what do we need to do, Ms. Varadaran, to ensure that they're not left out of receiving this tax credit months and months periodically away?
Thank you. Thank you for the question. And I want to say, first of all, that none of the proposals surrounding public banking are really going to get to the core of some of these issues that affect Black and Brown communities and Native American communities. These are historic injustices that have just compounded over time, just as interest does for capital. But I want to say, look, when we talk about markets in banking, it's a little bit of a misnomer because the federal government provides the basics infrastructure for the banking system, and we give banks a charter, and they have a monopoly on payments and financial transactions and credit. And if those banks are not able to or not making profits in rural communities, then we have to, as a democratic policy, country, then we have to ensure this access. And so I think one of the simplest solutions is the postal banking system, not because it's got all the bells and whistles, but because it has a historic legacy of doing it. It is still in those areas. And this is a way to actually help the post office actually maintain some of that revenue in the area. So my favored proposal for this particular topic is the post office. Thank you for the question.
Thank you. And Mr. Rothstein, as someone with a deep knowledge of this initiative, how do you foresee the program reaching the millions of Americans that continue to don't have access to a bank account? And I'm including white families too, not just Black families, not just Latino families. There are many white people, particularly in the rural areas. I'm dealing with them all the time. How can we help these people get the bank account?
Yeah, thank you, Mr. Representative, for the question. So I think there are a few ways. The first is, as I mentioned, we have about 90 plus coalitions around the country that are at the very local level working on this issue. They're trusted partners in this work, whether they're out of a treasurer's office, a mayor's office, a United Way, whatever it might be. They're working to find programs like the Child Tax Credit Program where people are getting paid or need to make payments. Also social services, wraparound social services. So finding where people are at with trusted advisors and counselors.
Mr. Rothstein, I'm going to have to cut you off. I'm sorry. The gentleman's time has expired. I'd now like to recognize Mr. Posey from Florida for his 5 minutes.
Thank you very much, Mr. Chairman.
Thank you.
Mr. Burlaw, what flaws or hurdles in public programs that private financial institutions don't have when reaching the underserved markets? Just some that exist. Yeah, what flaws or hurdles exist in public programs that private financial institutions don't have when they're reaching the underserved markets?
Talk about there are flaws as far as things that can hurt consumers, as far as with Fed accounts that it would have the Fed would have direct access to bank account info, and then data security all stored in one place would be vulnerable to hacking. Other things they would somewhat, I mean, displace also if deposits are there, then the banks and credit unions would not have that money to make loans to small business. I also think there's sort of an inherent tension when you get to postal banking, municipal banking, that you're both trying to serve consumers and make a profit for the government, I mean, or keep yourself afloat, and that's I mean, I've heard this postal banking being justified as both rescuing the post office and is, we need to provide lower rates to consumers. If you provide lower rates on borrowing, what does that do as far as the fiscal concerns of the post office? So there's that inherent tension there, like when you had postal banking and ended up that private banks were paying higher interest rate in the 60s, which was finally the reason for its demise as far as the original postal savings program.
Okay, thank you. What are the benefits of increasing the participation rate of the population in financial institutions beyond the direct benefits to the individual?
Well, it's that individual as part of financial institutions, whether it be banks and credit unions, and also would be that they could, they would be able to build up savings, build wealth for themselves, invest that, or maybe build businesses themselves. It would be very beneficial.
Thank you. If banks leave a community, what do the people in the now underserved communities do when they need emergency funds? Who tends to fill the void there?
There are, it's interesting, and my organization has pushed for de novo banks and credit unions, that we need to approve more new banks, because I think retail banks and having banks in locations do matter, but more and more people do banking online in in all sectors of income, and so I think there's just a combination of digital and having physical banks, as well as and de novo banks, both online, digital, and in physical locations, I think can really help fill that gap.
Thank you. What has been happening in the free market with financial access and banking consolidation?
Well, I think a lot. I mean, financial consolidation has been driven by some of the very costly mandates of Dodd-Frank. I've talked to some community banks and credit unions about things like, the cost of the qualified mortgage and other things. But I think the good news is you're seeing fintechs partner with, not just the large banks, with community banks to provide more access to credit, access to capital. And I think if you had some legal clarity about when banks could partner, who is the true lender, that would be very helpful.
Okay. Well, listen, thank you very much. I appreciate your frankness and the directness of your answers. Mr. Chairman, I see time is about to expire. I yield back.
Thank you, Mr. Posey. Yields back. The gentlelady from New York, the chairwoman of the Small Business Committee, Ms. Velasquez, is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member. Mr. Rothstein, 1 in 4 women and 1 in 2 trans individuals in the U.S. has been subject to severe physical violence by an intimate partner. And 48% of survivors, approximately 15.8 individuals, do not have safe access to bank account that is protected from a harm doer. First, how can we help ensure IPV survivors can gain access to checking and saving accounts? And second, how can we help ensure those accounts are protected from a harm doer?
Thank you for that question, Representative. It's an incredibly sensitive and important issue. I mentioned in my testimony that Bank On really works with coalitions as well as government partners to find places where people are making payments. The other piece, which I should have mentioned, also is on social services. So having bank account access for a social service like this is critical. Survivors need choices, so they need things, not just national accounts, but local community bank accounts as well. They need to know that they're safe in terms of accessing their money and that the accounts are in their name only. They need to be able to open those accounts easily, so things like that Bank On requires for these accounts to have a low minimum opening deposit of $25 or less. They also need to know that that everything's transparent. So if the account is $3 a month, it's always $3 a month.
Thank you. Thank you. Ms. Del Rio, great to see you. New York City's municipal ID card, IDNYC, was one of the first municipal ID cards that could be utilized to open a bank account or access traditional financial services. Can you speak to the important role municipal ID cards are playing in helping underserved communities gain access to bank accounts and other mainstream financial services?
Yes, thank you so much for that question. Our organization was one of many that led the campaign that resulted in the creation of IDNYC, a municipal ID card that's available to all New Yorkers, regardless of immigration status, homelessness, and other factors. More than 1.4 million New Yorkers have the ID, which was designed in close consultation with local credit unions and banks, as well as regulators. And one of the benefits of the ID, right, was that it was designed to meet the federal Know Your Customer requirements so that banks could accept that as the primary and sufficient ID to open accounts and extend other services. Despite all of that groundwork, none of the big banks have accepted IDNYC as the primary ID to open accounts, despite regulators issuing opinion letters and other guidance. That said, there's a strong network of community-based credit unions and smaller banks that have accepted and opened thousands upon thousands of accounts for New Yorkers that were previously excluded. But the fact that banks continue to reject that ID and discriminate against massive swaths of people.
Ms. Del Rio, I have other questions, so I just would like to ask a follow-up to that. Why do you think more banks haven't been willing to accept municipal ID cards as a primary form of ID, and what can Congress do to help further their utilization by banks?
Well, the banks have said that they needed guidance from the regulators. That guidance was secured and the policies did not change. We have bank compliance officers who tell us they believe that this population is more prone to fraud and exposes the banks to greater risk. We would argue that if the banks perceive these populations that rely on municipal ID cards to be more profitable, they would change their policies pretty quickly. We know that there are federal proposals now to secure more clear guidance from the banking regulators about municipal IDs. We think that examiners should actually look at banks' account opening policies, including their identification requirements, and identify potential discrimination against protected classes, including immigrants, and take strong action to change that.
Thank you. Mr. Chairman, I guess I have to yield back.
Gentlelady yields back. The gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Mr. Chairman. A recent FDI study illustrates that rural customers are more likely than their urban or suburban counterparts to do their banking in person at a branch. Unfortunately, the trend in bank consolidation and branch closures because of increased regulation in a post-Dodd-Frank world has disproportionately impacted rural areas. My bill, the Promoting Access to Capital in Underbanked Communities Act, is relatively straightforward, allowing for a phase-in of capital requirements for de novo institutions, including some provisions targeted toward underserved rural areas and several other common sense provisions to promote bank access in unbanked communities. My bill is supported by the ICBA and the ABA, and I hope the majority, Mr. Chairman, I hope the majority will agree to consider my bill in an upcoming markup. I've had good conversations with Mr. Lawson and Mr. Meeks about this legislation that would help new bank formation in rural and underserved areas. And I would urge Chairman Perlmutter to take a look at it.
Mr. Barr will take it under advisement.
Thank you very much. Mr. Berlau, how might my legislation, which would spark new bank formation, aid underserved communities, including unbanked citizens in rural areas?
Sounds like very good legislation. There was a real problem, not just with Dodd-Frank, although that was problem enough for smaller banks, but just about the new requirements, particularly the FDIC, about having to have so much capital, sometimes like 10 years worth of capital to form a new bank, that just discouraged some of the de novo applications there. But luckily, Chair McWilliams has been making de novo approvals a priority, as well as the bipartisan leadership at the National Credit Union Administration for de novo credit unions. But certainly, and I've been saying that if you have legislation to give the regulators incentive, or to make it to have certain reviews where they require it or streamline the process for de novo banks, that would be very important and very important.
And if I could reclaim my time, it's not just about bank consolidation, it's the dearth of new bank formation, the dearth of new charters, and that's really hurting underserved communities. If we really care about helping the unbanked, it would be to provide them with greater diversity in the financial services ecosystem, and that would be to encourage new bank formation. It is shocking to me how the majority's witnesses have identified as the solution to the problem of unbanked people in America, the solution is to destroy banks. That's what we're hearing today from the majority's witnesses. Think about this. If you put the post office in charge of banking America, consider the finances of the post office itself. The unfunded liabilities and the debt of the post office at the end of 2020 was $188 billion, more than 250% of its annual revenue. This is like asking the arsonists to put out the fire. It really is. It's absolutely crazy. And using the power of the government to crowd out the private sector, to politicize banking, will make it harder, not easier, for Americans to access financial services. The Paycheck Protection Program is an illustrative case study in the comparative efficiency and effectiveness of the private sector versus the government. Congress deputized private banks to deploy aid to small businesses, and it was incredibly successful. Meanwhile, other assistance programs administered by the government and government agencies have languished in bureaucracy. Yesterday, the HUD secretary was here, and we saw it firsthand. Congress appropriated $45 billion for emergency rental assistance, and less than 4% of it has actually reached renters. And we want to put the public sector in charge of banks? Really? Really? Politicizing banking is not a good idea. Mr. Pawar, you said when a bank chooses who to lend to and who not to lend to, it is making policy. Does that mean you oppose banks categorically excluding providing financial services to, say, the fossil energy sector?
I didn't say that. What I did say was that public banking, Fed accounts are simply gap fillers. A healthy market does not leave this many people behind.
Let's not replace the private banking system with government-run banks. Mr. Berlau, how would that impact low and moderate income individuals if the public sector was in charge of banking?
I think at the end was preservation. Investors are in danger that the public banks go discussing cuts that they can't fund fossil fuels, and you would do that if you
You talk about redlining. You put politicians in charge of allocating credit. You put bureaucrats in charge of allocating credit. You're going to get redlining everywhere. I yield back.
Gentleman yields back. Mr. Foster, or Mr. Green? Okay, Mr. Foster from Illinois is recognized for 5 minutes.
Thank you, Mr. Chairman. No matter how one prefers to expand access to banking, establishing a secure and legally traceable identity remains one of the biggest barriers to entry. Opening a bank account requires a documented, verifiable identity. Know Your Customer requirements mandate that banks must know with a high degree of certainty who their patrons are. The same applies to obtaining federal benefits without friction and fears of fraud. This makes things challenging for consumers who don't carry with them the specific legacy documents normally used to prove your identity. A recent report from 6 banking trade groups outlines verifiable identity as one of the chief reasons for individuals being unbanked or underbanked in America. A secure digital identity framework solves this problem. A properly designed digital identity is a more secure and more privacy-preserving form of identity that provides consumers with a way to authenticate and verify who they are without having to rely on your Social Security card or birth certificate. A digital ID would effectively eliminate most classes of consumer identity fraud as well. Unlike legacy identity methods, a digital ID is almost impossible to counterfeit. A government-provided digital identity would alleviate the challenges in obtaining ID and would pave the way for millions of Americans to be able to verify their identity and to participate in our increasingly online financial system. Many states, including, interestingly, many red states, are already moving rapidly on this by provisioning digital driver's license or mobile IDs to citizens who want. So there are 2 significant steps that Congress can make to encourage progress here. First, there is now real bipartisan agreement for providing universal access to affordable broadband for all Americans, with significant funding provided in the pending infrastructure proposals. Most of these proposals include some form of payments to states for assisting new broadband customers. So if these broadband connections are bundled with a state-issued secure digital ID, this would be transformative to access to banking. It would also pay for itself in fraud prevention costs alone. Secondly, the government has to get its act together in using modern identity systems and stop using things like Social Security numbers, birth dates, mother's maiden names, or easily hacked passwords as some sort of shared secret for authentication. Although it is not being noticed at this hearing, the recently introduced bipartisan Improving Digital Identity Act of 2021 provides a roadmap for an all-of-government approach to improving our digital identity ecosystem. I urge my colleagues to have a look at this and to support this legislation. So my questions, I guess, to Ms. Del Rio and to the whole panel, can you delineate some of the struggles that low-income individuals may have in obtaining a bank account, particularly as it pertains to proving their identity? And how would an improved government-provided digital ID framework help include more Americans in our financial system? And specifically, could you speak how a government-provided digital ID would disproportionately benefit lower income, rural, and minority consumers? I can start with Ms. Del Rio.
Yes, thanks for the question. As you noted, the digital ID proposal is not part of the hearing, so we would need to study that more closely. I do think that there are big questions around data collection, privacy, and other concerns that would need to be really carefully looked at. I also would say that the current Know Your Customer requirements that you cite are actually quite flexible, and they have been since the provisions were put into place, many years ago. And they actually allow for great flexibility with financial institutions to accept a wide range of US issued and foreign government issued ID, consular issued ID, municipal IDs, and so on. People without Social Security numbers can provide the identification number from these other ID cards. Despite this flexibility that the regulators have consistently provided, the banks too often go far beyond that, and they create impediments that effectively block hundreds of thousands of Americans from the banking system. Other challenges that we see and other barriers include, again, these overdraft fees that many of us have spoken about. I just want to underscore, there's research by Center for Responsible Lending that shows it's a very small percentage, 9% of account holders that pay more than 80% of these billions of dollars in overdraft fees. Hidden fees that the banks
I was referring specifically just to the digital ID aspects. Do other members of the panel have comments on this and the benefits and how they're how this is affecting access to banking and I guess my time is about to run out, but if you have any comments, and specifically on the other legislation that I mentioned, I'd be interested in your response for the record on that. Thank you. Yield back.
Dr. Foster yields back. Gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Mr. Chairman. In full disclosure to our witnesses, I'm just a small business owner from rural Texas. Been there 51 years. And I've heard the post office today is the most trusted brand name in America. Well, it's not in my district. And I would hate to think that the post office is going to be an example for all of us to follow in the banking system. Or maybe I got a better idea. How about Amtrak running the banking system? So if you want to increase financial inclusion, we're going to need to empower the private sector to develop innovative new solutions to bring people into the banking system. In order to accomplish this goal, the government, of course, needs tax policies that will incentivize our country's entrepreneurs to take risk and deploy their own capital to solve these problems. And, I would say simply, I can fix it. Let's just cut taxes for everybody so people have more money in their pocket. Then they got a bigger check to take to the bank and create an account. That's what it's all about. Unfortunately, we've seen some tax proposals coming from the Biden administration that will make these types of investments and a bigger check less attractive by significantly increasing the carried interest in capital gains taxes. Well, this is stupid. Without proper profit incentives, we're going to have a hard time convincing investors like all of you to go the extra mile to connect people who are unbanked. So, Mr. Berlau, can you talk about how the Biden administration proposed carried interest tax provision would hurt venture capital firms and other angel investors who are taking the financial risk to bring new financial products to the market and hurt the small investor?
Yes, thank you. I have written it would. I mean, all partnerships are sort of based on carried interest, although it's being sold as private equity and hedge fund. I mean, real estate partnerships, angel investors, just some basic small business partnerships, and not even just the rate, but going back 30 years as far as saying who contributed this capital to the firm. It would actually hurt small business partnerships and tilt things through to corporations. So I think it would be destructive more than some people are anticipating.
Yeah. It's double taxation, and you'd have fewer investors. So secondly, in speaking with businesses during the Trump administration, many of them felt confidence in their operations because there was certainty around the regulatory environment. They were not afraid there would be suddenly a costly new regulation coming out of Washington, D.C. that would force them to hire more compliance officers than, say, in a bank, more compliance officers and loan officers that don't provide any additional value for their company or shareholders. So now that there is a new administration in town, as they say, and a new sheriff in town, the sentiment has changed to uncertainty again and fear among business owners. So, Mr. Berlau, can you discuss how this regulatory uncertainty coming out of the Biden administration can truly affect small business, big business, and business investment?
Yes, regulatory uncertainty can certainly affect investors and small business. But however, I am the eternal optimist, and CEI is a nonpartisan organization, and we've worked on things like as far as I mentioned the Safe Banking Act, which would provide clarity for a lot of banks in states where marijuana is now legal, as well as in the Obama administration, the Jumpstart Our Business Startups Act that made it to easier to do equity crowdfunding without having to show that you were a Fortune 500 company. So I'm hopeful, but yes, that always the threat of new heavy-handed regulation is threatening and hurts the economy.
No question about it. We've heard some discussions of the Federal Reserve offering bank accounts as a way to get more people included in the financial system. And considering we have so many banks, credit unions, and fintech companies already offering this service, I don't really understand how a public option would solve this problem, because we know when the government gets involved in something, it just creates another problem. So another question to you, Mr. Berlau, can you talk quickly about some of the negative side effects of creating a Fed account system?
Yes, there are some negative accounts. I think for privacy, as far as this is the Fed having that directly having that data of customers, and the data security issues of basically having the government control like a blockchain or a ledger of all the data there.
Okay, thank you, and I yield my time back, Mr. Chairman.
Gentleman yields back. The gentlewoman from Massachusetts, Ms. Presley, who is also the vice chair of this subcommittee, is now recognized for 5 minutes.
Thank you, Mr. Chair. In full disclosure, I'm a Black woman growing up in America who was raised in a red line neighborhood, and who once I was working as a full-time unpaid congressional intern and working 3 part-time jobs, piecing together various money orders to pay rent, to pay utilities. I cashed my check at a check cashing facility. And I did that because that is what I grew up in proximity to. Neighborhoods like Boston and Dorchester and Roxbury and East Boston, which I represent in the Massachusetts 7th Congressional District, predominantly Black, Hispanic, Latinx, have 57% of the city's check cashing locations, yet only 12% of the city's commercial bank branches. So for my constituents and the estimated 1 in 5 people across America who are unbanked or underbanked, lack of access and fractured trust with financial institutions is incredibly expensive. The cost of cashing checks alone can cost up to $2,400 for households with an annual income of $32,000, just cashing checks. That doesn't even include the costs and penalties of payday loans and the cost of not having credit. Being credit invisible can make it virtually impossible to finance a car, an education, a home, and even a cell phone plan. Banking institutions understand the power of their products. It is not an accident that communities of color have less access to the wealth-building resources and services that banks offer, but are instead surrounded by high-cost, exploitive options like payday lenders and pawn shops. Banking deserts and the implicit and explicit exclusionary practices of financial institutions are widening the racial wealth gap, and we need bold legislative action to build an inclusive, equitable economy. Ms. Baradaran, I briefly described how few commercial bank branches exist in the communities of color in my district and throughout the country. However, these communities do have post offices. Can you describe how an expansion of USPS services to include banking would remove structural barriers for people who are unbanked?
Thank you so much for the question and for drawing attention to the structural inequalities here. The reason why those neighborhoods do not have banks was very much a policy decision, and as Mr. Pawar said earlier, that is why credit is public policy, because the majority of credit products that are historically have built the middle class were underwritten, guaranteed by the federal government, and those communities that were redlined just specifically because they were Black or brown did not get those loans. So that's what we mean by credit is a public policy issue. And same with the payment system. The Federal Reserve controls the payments. We have ID requirements because Congress has decided, I think rightfully, that we want to make sure people aren't sending money for illegal things through the banking system. This is how the public structure of the banking system works. And certain communities have been left out of that historically. And those communities not only didn't get the credits to build wealth, and didn't get to, that's why we have the racial wealth gap, but also, the salt on the wounds is exactly as you said, the check cashing fees, the overdraft fees, the payday lending fees. So we're talking about even people who are banked, who have to go get a payday loan because of these structural inequalities, end up paying way more than others. So that's just salt on the wounds. That's not even getting to the structural roots of these issues. And the postal bank, exactly, is just one solution of many that we need to really tackle this massive problem. And that's just because it's already there. Those neighborhoods trust it. We're not talking about the bells and whistles, but those can come later once people get that account. Thanks.
Thank you so much. And Ms. Pawar, how would some of the greatest challenges of being unbanked be solved by a national baby bonds program? Senator Booker and I have introduced the American Opportunity Accounts Act, which would ensure that every child at birth not only has a basic savings account, but also has that account is seeded with funds to be used for wealth building activities like starting a business or buying a home. Could you offer your opinion on the benefits of baby bonds?
Yes.
Oh, there you are, Mr. Pawar.
Thank you for that question. One of the things that we have learned over the last 18 months that pre-existed before the pandemic is that we lack the financial infrastructure to deliver cash to people quickly. And so when we think about baby bonds or we think about Fed accounts, what we need to do is have a base level of infrastructure so that everyone can access benefits that they are entitled to. They can receive money, they can pay bills, et cetera, et cetera. So it would simply function as a conduit to be able to have that money parked somewhere safely without subject to extraction and in a way that is accessible universally to everybody.
Thank you.
Thank you. Gentlelady's time has expired. We now turn to Mr. Loudermilk of Georgia for his 5 minutes.
Thank you, Mr. Chairman. I appreciate the opportunity to be here, and I'm so glad you needed me to be here. That's encouraging. James Garfield, the president, said, if Congress is reckless and ignorant and corrupt, it's because the people accept recklessness, ignorance, and corruption. That is what the American people think about this institution. And just because they think that we're reckless, ignorant, and corrupt doesn't mean that we have to meet their expectations. Just in the short time I've been here, I have seen some really bad ideas proposed. And this one has to be near the top. I mean, I can already see numerous problems with expanding the government bureaucracy to be involved in helping people with their bank accounts. Think of this. Only 25% of Americans trust that the federal government works in their interest. 25%. Simple math, I'm not a banker either, but simple math is 75% of Americans don't trust the federal government. But we think that they're going to trust us with their bank accounts. Look, let's talk about customer service. Customer service is at an all-time low in the federal government. We don't even have to bring up efficiency. Look at how much money our government spends and how inefficient it is. If my colleagues don't believe this, how about making a call to your constituent services operation and ask them if the government is efficient, if it's responsive, and if it provides any customer service? So what I'm wondering is, if this was to be enacted, are our customer service reps now going to be handling people's deposits and withdrawals and dealing with government agencies that are non-responsive already? I think this whole proposal is doomed to failure, not to the American taxpayers, which it would be, but to the very people that it supposedly is trying to help. Now think about who the base would be. According to FDIC data, 95% of American households are banked. That means 5% are unbanked. Of that 5%, the majority of them are because they don't want a checking account, but all of a sudden we're going to let the post office handle it. Oh, now everybody's going to want a checking account. I don't think so. So that means less than 2.5% of the people would actually be interested in this type of service. I would think that improving some of our existing system, instead of overhauling it and creating a new bureaucracy, would be the answer. And especially when you look at these agencies and bureaucracies that can't even balance their own checkbooks, but we're going to trust them to help us balance ours. I think this is doomed to failure. Fortunately, the growth of online banking has made it easier to open checking accounts. The FDIC Chief Innovation Officer said the best way of banking the underbanked is through technology. Through technology. I think that's where the answer is, not growing bureaucracies and giving the government more control over the American people. So, Mr. Bilal, is there any evidence that the banking system is failing to adequately meet customers' needs?
I think you're seeing fintech and community banks and credit unions rise to the occasion, and I think you would see them even doing more so if you would streamline some regulations, clarify who the true lender is, and bank fintech partnerships, and you would see even more if some of the red tape were lifted.
So how has FinTech actually made it easier to open a checking account?
Well, things like for Dave and Ernan and just being able to just put that on your phone, having sometimes low cost advance either to cover like what would be an overdraft or against or to get what you've earned before your paycheck comes. That is all, and they partner with banks, so that's sometimes the smaller banks. That has made it easier for a lot of Americans.
So I'm quickly running out of time, but what improvements can we make to the existing system to help this less than 2.5% that would actually want a banking account but doesn't have one?
I think both things like Congressman Barr's bill with encouraging de novo banks, new banks being formed, and also the just clarifying who is the true lender, clarifying valid when made that that banks if they have liquidity behind these loans, they would certainly make more of them.
Okay, well, thank you for that. I appreciate that. And Mr. Barr's bill is a good idea. Thank you, Mr. Chair, and I yield back.
Gentleman yields back. The gentleman from Texas, Mr. Green, who's also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I happen to think that Ms. Ocasio-Cortez and Mr. Tlaib have good ideas. I happen to think that the Public Banking Act of 2021 is worthy of consideration. I happen to believe that you don't have to be a banker to serve on the Financial Services Committee. In fact, most of us aren't. Very few of us are bankers. Very few of us have any banking experience at all. Yet we serve on the committee that regulates not only banking, but also other financial institutions. So, Mr. Pawar, I want you to know that I appreciate your testimony today. I think you've been an outstanding witness. And I don't know that you have to have lived something to appreciate it and understand it. With reference to banking, poor people, regardless of color, regardless of hue, have a great difficulty when it comes to paying their bills. You've heard Ms. Presley. Touched my heart to hear her talk about her circumstance. But they have great difficulty. Like Ms. Presley, I grew up in poverty. There were very few banks, if any at all, that I actually went into as a child in my neighborhood. Why wouldn't we want to help people who have to go to the check cashers, to these places where they're paying unusually high fees to get what we get at no cost? Most members of this committee have no free checking. I'd bet my life on it. We seem to think that the rest of the world exists in the bubble that we live in. We are blessed. Unfortunately, we don't understand the basic premise for being blessed, and that is that you should be a blessing to others who need help. They don't live in the suites of life, the C-suites. Many of them live in the streets of life. Some of them live under bridges. They live in lean-tos, tents. There seems to be a basic belief among some that the rich need more to do more and the poor can do more with less. At some point, we have to concern ourselves with those who are not as fortunate as we are. And we who sit in these seats are some very fortunate people. So yes, I support the notion that we should promote the formation of public banks operated by local or state governments through the creation of a public banking incubator program that provides grants and technical assistance to new public banks. Mr. Ocasio-Cortez, Mr. Lieb, I think very highly of what you're attempting to do. By the way, I never had a conversation with them about this. These are some very intelligent people. They don't have crazy ideas simply because they're different, simply because they're innovators, simply because they understand another side of life. I think this would help many of my constituents who are not as fortunate as most of the people who serve on this committee. And I yield back my 30 seconds. Thank you, Mr. Chairman.
Thank you, Mr. Green. You yield back. Mr. Budd from North Carolina is now recognized for 5 minutes.
I thank the chair. Mr. Bilal, we need to be doing more as a society to give Americans the tools that they need to be plugged into the financial system. So it's very concerning to me that a majority of students, they graduate from high school, some of them even graduate from college, and they don't know how to balance a checkbook or open a checking account, manage interest, procure a mortgage. So without this basic knowledge, it's difficult for a lot of folks to deal with complex financial situations that come up later in life, or even at that point in life. So that's why I've worked on financial education and financial literacy legislation like the FLIP Act, which helps build that foundation for young Americans. So Mr. Bilal, what are additional ways we can educate Americans about the resources that are available to them and get them participating in the financial system earlier, rather than feeling like a victim or that it's impossible? So how can we get them involved?
Well, I think that, and your legislation is a good idea. I mean, and also the fintech apps about showing just what you do with with a small amount of money, either saving or investing that is a way to show how to you go where the young people are as far as online or on the apps, and it's also something that parents and teachers should not be afraid to talk about money, and just at an early age develop saving and investing and shopping for bargains, those habits, as well as churches and synagogues and places of faith.
Thank you. Slightly different topic, Mr. Bilal, but quickly, if you could answer, do we really want the federal government overseeing our financial transactions history?
I don't think we do. Yeah. I don't think it has a good record as far as respecting privacy or data security or other things. And I appreciate Professor Bharara having written a book about George Washington, invoking him as far as the post office. But I've also written that as a private citizen, he helped found the Bank of Alexandria. So I think he could see, that banks and post offices serve different functions and probably shouldn't be mixed.
Thank you. So many of the so-called solutions that I hear about, they seem to have a really counterproductive effect. Like a lot of the solutions that come from the left, they sound sweet, compassionate. Sometimes they're even hypnotic or sermon-like, but they really always have a counterproductive effect. They hurt the unbanked and the underbanked consumers even further. Bad policies like imposing a 36% nationwide APR, thinning their credit files, postal banking, repealing the true lender law, it just makes the problems worse. So are there regulatory hurdles that we can reduce that would expand access to banking for the unbanked?
As I said, before we had the Durbin Amendment, before debit card fees were capped in Dodd-Frank for retailers, and retailers had to pay the costs of what cybersecurity and everything, then banks were able to give more free checking accounts at 76% in 2009. So we could repeal that, as well as I think just having encouraging more bank fintech partnership by setting standards for who is the true lender, and valid when made as far as being able to have a liquid secondary market for these type of loans. Just as more.
Mr. Bill, let me just summarize real quick. So you're saying the Durbin Amendment actually hurt the underbanked?
Very much so.
Thank you.
By
Okay.
1 million.
Thank you. We've talked a lot about the important role that the private sector plays in expanding access to banking with innovation. So one area is decentralized finance, which removes financial intermediaries and puts consumers in control of their finances with products like peer-to-peer lending. What is an example, or what are some thoughts on the promise of new tools like this to help the underbanked and unbanked?
I think cryptocurrency, decentralized finance, blockchain even with blockchain, with things like Congressman Foster was mentioning with IDs, can provide a lot of new tools, just as they are in some third world countries and things like that for the poor and the middle class.
Very good. I'll yield back my remaining time. Thanks for being here.
Thank you.
Thank you, Mr. Budd. You yield back. Mr. Torres, a gentleman from New York, is now recognized for 5 minutes.
Thank you, Mr. Chair. I just want to, someone brought up fintech as a possible solution to the crisis of the unbanked. It's worth noting that 50% or nearly 50% of households living in poverty in New York City have no access to the internet. So if you're at the wrong end of the digital divide, fintech is of no value to you, brings you no closer into the mainstream of the financial system. I represent one of the most unbanked congressional districts in the country. According to the FDIC in the United States, 5.4% of Americans are unbanked. In New York City, the rate is 9.4%. In the Bronx, it's 17.7%. So in the Bronx, the number of unbanked people is nearly triple the national average. And the lack of banking access leaves communities like mine wide open to exploitation by predatory finance, particularly check cashing. According to the Department of Consumer Affairs, New Yorkers on average spend more than $200 million a year on check cashing fees. And in two neighborhoods in particular, in the South Bronx, which is primarily Latino, and in Southeast Queens, which is primarily African American, low-income New Yorkers in those two neighborhoods spend more than $17 million a year on check cashing fees. Is it fair to say that we have a financial system that robs poor people of their fixed income, that essentially siphons the most from those who have the least? Professor, I don't know if you want to respond to that.
I think that would be a safe statement, yes. I can elaborate if you'd like.
Sure, no, I can go on. I'm no expert on banking, but it seems to me the business model is straightforward. Banks collect deposits and then lend out those deposits. And banks have an incentive to collect larger deposits in order to make larger loans, in order to earn larger profits. And so given those incentives, the market often fails to serve the lowest income Americans who cannot afford minimum balance requirements and overdraft fees. And whenever there's a market failure, it is not unusual for the government to intervene with a public option, right? There are public providers of healthcare, there are public providers of housing, there are public providers of higher education. There's ample precedent for the government intervening with a public option in the midst of a market failure. I don't know if you want to comment on that.
Yes, I mean, it's exactly right. I mean, banks, it costs the same amount of overhead to take a $500,000 deposit from a corporate client than a $100 deposit from a person. And so the cost benefit, the economics of banking doesn't support those kind of small accounts. And the reason we had a robust community banking sector back, it wasn't Dodd-Frank that killed it, it was way before that, was that we purposefully regulated banks such that they couldn't branch, they couldn't get larger. Every community had to have a bank branch, and that was how banks could afford to take these smaller deposits, because they didn't have that heightened competition that we see now. In today's market, it's really difficult for small banks to lend or to give deposit accounts to low-income people, especially in LMI communities where there aren't the profits. So it's not that the banks are greedy or bad or especially gaming the system. It's just that the system doesn't make it such that they can lend and give deposits to low-income people.
Mr. Rothstein, I have a question about bank-on accounts. Are bank-on accounts no overdraft?
Thank you for the question, Representative. Yes, all bank-on accounts have no overdraft fees and no insufficient fund charges on them.
So there are about 10,000 banks and credit unions in the United States. How many of them offer bank-on accounts?
To date, I think we are at 108, including credit unions.
So why is purchase, and of the 108, how many are banks?
I believe, I'll get you a list after the hearing, but
Is it majority banks or credit unions?
Majority banks.
Okay,
Majority banks.
why is the participation so negligible?
Well, I think one, it's a newer program.
How long has it been around?
So we have been certifying financial institutions for 6 years now. The big piece I would say, though, again, is if you look at the market share and the number of branches covered, it's very large. So about 40% of all the branches of banks in the country offer at least one bank-on certified account. And I would say probably, my hope is by September, we're going to be around 45%.
Should it be mandatory rather than voluntary?
Well, thank you, Representative.
I would say yes, but I'm curious to know your.
Well, that would either be tremendous job security for me, or no, or I'd have to find a new thing to do. No, I have mixed feelings. I really do. I think that part of the reason that Bank On works so well is that the banks and credit unions themselves brand these accounts and fit them into their suite of accounts. And so, if we take too much of a cookie cutter approach in mandating the accounts, and we take away the creativity, and we take away the ability for them to position the accounts in their community, then we're not doing.
I'm in the red, so my time has expired.
Gentleman's time has expired. Sorry to cut you off again, Mr. Rothstein.
Fine.
Like to recognize now the gentleman from Tennessee, Mr. Kustoff, for 5 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses for appearing today. If I could, Mr. Berlaw, can you talk about, I know we're all concerned about the loss of bank branches over the last 10 to 12 years. Can you talk about the effect that Dodd-Frank had on the exasperation, if you will, of bank branch losses or decreases over the past 10 to 12 years?
Yes. Well, banks, there was a loss of community banks even before Dodd-Frank, part of market consolidation. But Harvard's Kennedy School did a study, which I'm happy to share with you or others who were interested, who just found it just rapidly accelerated after Dodd-Frank. I mean, not only like the State National Bank of Big Spring, Texas, it didn't close, but it was saying it would just because of some of the regulations, it was not offering. It was just not offering mortgages because it was too expensive to comply with the qualified mortgage, and it had very few, if any, defaults. I think it may have had no defaults for a period of 20 years. So it just, it accelerated trends and made it costly for both banks and credit unions to both operate, and some had to close or merge with others.
So Dodd-Frank is a clear factor in the decreasing number of bank branches over the last 10 to 11, 12 years.
Yes, there was a Harvard Kennedy School study that showed that, as well as others, as well as if you talk to the Independent Community Bankers of America, the Credit Union National Association, other groups representing community banks and credit unions, they will talk about that. That's certainly been a significant, substantial factor.
Thank you, Mr. Berlaw. If you could you talk about the true lender rule, and was the rule, in your opinion, was it necessary to create any certainty within the industry?
It certainly would have helped, because basically it would have brought the certainty that say the larger banks have when they're issuing credit cards, and they have follow national rather than state rules, say on interest rates. Large banks already have that for credit cards, but smaller banks, which don't have the infrastructure for underwriting that some fintech firms have, it would have brought certainty to them that they would have been able to do this and have under the same privileges of the law that the larger banks. Plus, the loans also certainly would still be subject to the bank rules, like federal rules like fair lending and ability to repay.
True statement that rule does have an impact on financial inclusion.
Yeah, it would have. It's if it were it not repealed by Congress. So yes, it very much would have helped financial inclusion. And I hope Congress can do a bipartisan solution, of a similar rule.
Thank you, Mr. Burlaw. If I could, I don't think you have the benefit of this letter. The chairman and the ranking member were sent a letter yesterday from the Consumer Bankers Association about some of the proposed legislation. They, in the letter that I think the committee members got, or at least I got, they addressed the Public Banking Act of 2021. I want to read a statement to you from the letter and ask you whether you agree with it. This is about the Public Banking Act of 2021. The entrance of another government subsidized entry into the consumer financial market would not only affect the competitiveness of the nation's thousands of financial institutions currently serving consumers and small businesses, it would also expose American taxpayers to an increased financial risk. Would you agree with that statement or disagree with it?
I certainly would. That's in my testimony.
Another statement from the letter. The creation of a government-sponsored public bank option with endless resources will likely leave many private institutions with a distinct competitive disadvantage within the financial services marketplace. Would you agree or disagree with that statement?
I certainly would agree. And then with the government institution, it would also give the government, more discretion as far as if they wanted to cut off everything from fossil fuel, or say one government didn't like marijuana, they could cut that off and people would have less choices.
Thank you, Mr. Burlaw. My time is expiring. I yield back my 4 seconds.
Gentleman yields back his 4 seconds. The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Mr. Chairman, and thank you for this hearing. I appreciate it very much. I apologize I missed part of it. I had another hearing at exactly the same time. I did come in time, however, to hear one of my colleagues say that the public doesn't trust us. Well, of course they don't trust us. When you can't hear us speak with one voice that we should be vaccinated. It's important to get vaccinated. When we clearly don't say that, yes, President Trump lost the last election, and when we don't say clearly that, yes, there was an insurrection here, and in fact, yes, the Capitol was attacked. It wasn't just tourists walking around. But the part that I found kind of interesting, really, apart from all that silliness, was the part about you can't trust federal government, you can't trust a public bank. Because I would ask, well, are you part of FERS, the Federal Employees Retirement System? And they probably say, yeah, okay, well, that's the feds, that's the same people. Okay, now are you part of TSP? Well, yeah, okay. Well, that's the thrift savings plan that's made available to members of Congress. Okay, so that's 2 public banks you're involved with. How about Social Security? Well, yeah, of course, Social Security too. Well, wait a minute. I thought you don't trust the public, that the feds, they can't chew and chew gum and walk at the same time, yet you're involved in all these things. What about that? Well, that's different. That's really different. We can't trust it when when the idea comes from somebody else. Well, I think it's a very intriguing idea that I think we should pursue. And so I would like to ask, and again, I appreciate Ms. Ocasio-Cortez bringing it forward very much. I would like to ask Ms. Del Rio, in your testimony, you state that the public banking affords communities an opportunity to expand fair banking access and deepen the public investment in affordable housing and other critical economic sectors. If you could speak a little bit about that, but focus on the housing for me. That's the part that I think is very, very problematic for so many Americans. You go ahead, if you don't mind.
Yes, thank you so much for that question. I want to be really clear. Public banking for us and the coalitions we work with is it's part of what we need to address market failure by our current banking system. And what we envision a public bank doing is really using the power of public deposits. For example, in the city of New York, we have an annual budget of $98 billion, and that money sits right now in Wall Street banks that are not reinvesting it equitably in our local communities and our economy. What a public bank could do is, first of all, strengthen existing networks of community development, loan funds, and credit unions. These CDFIs that have filled the gaps that banks have left in low-income neighborhoods and communities of color, and that are providing full-service branches, low-cost and free accounts, small loans at non-usurious rates. And these are small institutions that do not have the economies of scale that big banks do. So this can be done, and a public bank would strengthen those institutions and help millions of individuals across the country gain access to fair and equitable financial services. Beyond that, as you mentioned, it would partner with these CDFI lenders and in other ways strengthen investments in truly affordable housing, in small business development, and in other needs. We envision that happening in several ways, one of which could be in participation lending. For example, with these CDFI lenders, credit unions do this routinely. And what it would do is allow small community-based lenders that know their local community needs to be able to punch above their weight, underwrite projects that they on their own are too small to finance, using the leverage that a public bank and public funds would provide to those banks. Public banks could also create secondary markets to purchase loans. It could partner with credit unions in all sorts of ways to address liquidity constraints that they face and to make sure that they also are not over-concentrated in certain industries and certain parts of their lending. So it's really not a radical solution so much as taking what's working already and building on it with public funds.
Thank you for that very important discussion. I appreciate it. I do want to mention two things. One, a shout out to some banks. In California, we did convince many of the banks and credit unions to use the matricula consular so we could have people who were undocumented or didn't have the ability to show a driver's license, or others now they do, to be banked. And that, I think, was very, very positive. So a shout out to them. And lastly, I would say, I do find it so hypocritical that people attack the federal government and they're part of the federal government. Say that it doesn't work, and yet here we are, we're part of it. Anyway, with that, I yield back. Thank you, Mr. Chair.
Gentleman yields back. I'd like to just say, Ms. Del Rio, it's not a novel concept. Alexander Hamilton actually wanted to have a national bank. So let's, I appreciate gentlemen's questions. The gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Good afternoon, and thank you, Chairman Perlmutter and Ranking Member Lukemeyer, for holding this hearing today, and thank you to our witnesses for being here today. As I've listened to, and unfortunately I haven't gotten to hear all the testimony and questioning, but as I listened early on to your statements, I couldn't help but remember back to my youth as a 4-H member in Putnam County, and my 4-H agents, Scott Chadwell and Donna Klaus, who came to my 4th grade class with a novel idea that was supported by one of our local banks at that time called First National Bank, which was the 4-H Thrift Club. And the idea was you go to your bank, you make the pilgrimage down to the local bank branch, which in my case wasn't too far away at that time. I lived in a small town, and you open a bank account, Chairman Perlmutter, and you make $1 per month deposit into that account. And if you did that for a whole year, then the bank gave you a reward, which in many cases was things like a ruler or a backpack or something like that that was useful. And my wife calls me a pack rat, and I think she's right, because I still have all of those tokens of appreciation from that first bank account, which I kept open until I started college. It wasn't a very impressive sum that I had saved over the 8-10 year period, but the lesson that I learned from that early experience of having a bank account and knowing my banker and getting comfortable going into the bank has proven to be very valuable in life. As I listened to the discussion today, I noted some of the comments that I took note of, and one of Mr. Pawar, you said something about having banking concentrated into the hands of a few, and I can think of no more pernicious concentration than a public option. In my time here in Washington, what I have come to conclude is that having the government be in charge of things is a particularly bad idea. There are a few things the government needs to be in charge of: public safety and policing and protecting us from outside threats. Those are things the government should be doing. But getting the government involved in banking is truly, I think, the worst idea that I've heard as a member of Congress, and I hope it doesn't happen, and I'll do everything I can to try to deter that from happening. So I think about where we are with respect to banking in this country and the number of unbanked people, and I can't help but reflect upon the unending appetite for imposing greater regulations, which I think inevitably leads to making banking less accessible, less available, more expensive for Americans. And I would credit that as probably the number one ill that we should be trying to fix, is to lower the cost of banking by eliminating unnecessary, redundant, duplicative regulations that make banking more expensive. As we have this discussion, I think it's important to remember that unbanked households are more prevalent in rural areas. Much of the 6th District of Tennessee that I represent is rural, where they account for 8.6% of total households. Those are unbanked households in the rural areas. A large portion of my district, as I say, is in rural areas, and rural communities have seen increasing cost of accessing financial services, in part due to branch closures. We've heard that discussed today. As of the third quarter of 2020, there were 13,000 fewer banks. I think we've heard that data today as well in rural communities than in the 1980s. Where my farm is, in the rural part of my district, that's very true, with the 2 closest branches having closed in recent years. Mr. Burlow, could you discuss how fintechs could step in to try and fill that gap in rural communities?
I think they could fill that gap just with as far as with people going online. Also, they could partner with retail banks that wanted to open there, and hopefully we would need the keep pushing on the agencies and the de novo banks, but they could partner as helping to provide underwriting and all types of services to the rural banks.
And explain how the importance of expanding broadband plays into utilizing this emerging technology.
I think it's very important. We should really have the incentives to invest in broadband there.
I agree with you, yet I also welcome the news that Mr. Rothstein of your efforts, which reminded me of my early experience, by the way. So I commend you for the work you're doing in helping make affordable bank accounts available. So keep up the good work, and I hope that we can turn back the tide of interest in public takeover of the banking industry. And with that, I yield back the balance of my time.
Gentleman yields back. The gentleman from California, Mr. Sherman, who's also the chair of the subcommittee on investor protection, is recognized for 5 minutes.
Thank you. It's interesting to hear this discussion of the true lender issue. It's my colleagues who usually support states' rights are now bemoaning the fact that a device used, a subterfuge used in conjunction with federal regulators to defeat state laws was swept aside by this Congress. And I look forward to those who have talked about the true lender law to embrace the idea of the federal government making all the decisions. I do hope that one of our witnesses, for the record, because this isn't a fair question to ask you, would take a look at how many Americans don't just live more than 15 minutes from a financial institution branch, but are also never within 15 minutes when they either go shop for food or when they work. I, for example, live in the least urban part of my own district, so I'm 15 minutes away from everything. But I got to get food, and there's a bank next door. We need to provide people with more knowledge, particularly in the high schools. We need to encourage employers to engage in direct deposit with a bank. That means the bank will cut a better deal for the customer, and you'll bring the worker into the bank. And pay is too damn low, which is why we don't have so many Americans that don't have a net worth of $1,000 and get hit with overdraft protections, payday fees, et cetera. Mr. Burlow, I want to thank the committee for including in today's hearing a discussion draft that would allow all federal credit unions to add underserved areas to their field of membership and expand the ability of credit unions to lend to their member businesses in underserved areas. With regard to the Expanding Financial Access for Underserved Communities Act, you write in your testimony that you support that approach. How, in your view, would this bill help those consumers and small businesses who don't currently have access to financial services?
It would allow credit unions, which are limited by field of membership rules now, to expand if into those underserved areas if they think that would be, they could, maintain their safety and soundness. And the regulator would have to, the National Credit Union Administration would have to approve that. But it would be, liberalizing some of the red tape around credit unions, which would be a very good idea. Also, I think it would be good to let credit unions make more business loans to raise or repeal the member business lending cap.
Thank you. Ms. Daran, when it comes to the possibility of public banking options, I'm a political realist. I think the operation and political hurdles are not going to cause that to be adopted in my lifetime. Some members of the committee are younger. So in terms of addressing people's needs, I wonder whether it might make sense to focus on some other more available tools. In your written testimony, you say that Congress should focus on strengthening community reinvestment regulations. Could you explain how the Community Reinvestment Act might be better leveraged to ensure that all Americans have access to financial services, depository institution services?
Thank you for the question. The regulators have recently proposed a new CRA rule for notice and comment, and I do think that there are some really robust changes to the CRA that could benefit a lot of communities. And this is it's not going to help a lot of the communities that don't have bank branches, though, because the CRA is geographically focused, and that's one thing that the CRA reform can focus on, is that there's a lot of CRA deserts around where there are banking deserts, where the CRA requirements don't apply because they're geographically constrained. So that's one reform I think that could potentially fix this. And I think, I would not limit our political imaginations for what is possible. What the Federal Reserve did during the COVID crisis was very, very much out of line with what it had done before, and it was very good policy, and it had great work, and that is a public bank. We have actually a public bank, and so the idea here is just to extend the reach.
And I would hope that CRA would not only direct banks into better serving the areas they do serve, but also give them credit for serving any area that's completely unserved. I'll put in a plug for my own hearing, 2:00. Bond rating agencies, be here if you're a member of the committee, whether you're a member of the sub or not. I yield back.
Thank you, Mr. Sherman. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Burlow, what flaws and/or exist in public programs such as the post office that private financial institutions don't have when attempting to reach underserved markets?
I think the fact that private institutions compete against each other, and they compete for new customers, and they're always looking for for innovation is the key. And I think the post office, again, there is a tension there between is this to rescue the post office, or is this the post office to rescue others? And the flaws also, I don't think, as far as the Fed accounts, we want the government having direct access to sensitive financial data rather than, having to subpoena a private bank. You have that layer there consistent with the Fourth Amendment, but it's like, there have been data breaches in the government, and as well as selective leaks. So, I mean, who knows, with Fed account or government, basically having its own blockchain rather it being distributed, what could happen there? Plus the question about, it being arbitrarily cutting off certain industries, as the Public Banking Act does for fossil fuels.
I feel like you're reading my mind. I'm going to go in a little different direction now. So would a market-based solution that leverages an existing financial system, such as credit unions, get these financial products and services into the underserved markets faster? And would the cost be less than with a government program?
I would think so. If we push more, de novo credit unions, get more, new entrants into the system, and what's already going on with the community banks and credit unions and some of the entrepreneurial fintech firms, yes, it's happening. And if we clear up some of the red tape, it would happen even faster.
And we have thousands of credit unions and small banks across this country. Why wouldn't we just incentivize those entities? And what would happen to them if a postal banking option was created?
Well, it would be government subsidized competition with the privileges of that, and it would also especially with Fed accounts, you're talking about having the deposits that are used to make loans now. So you'd see sort of a suffering across the system as far as drying up for business loans. Some of the bank associations have warned about that.
And the credit unions and small banks, they employ tens of thousands of people all over this country. And would they likely not be able to compete in this market and therefore lose market share and likely therefore lose jobs?
I think yes, it would certainly, when you have the advantages of the government and a budget from that, a budget that's all tied to a federal government that can print its own money. Yes, that's a significant competitive advantage they would have over credit unions and community banks.
But I imagine they could go get jobs at the post office. A lot of new jobs there. So I don't understand this proposal. I think this is a very important issue that we need to have good policy to pursue and fix it and make legitimate strides. But I think my colleague just said that this is not a proposal that will likely happen during his lifetime. So I would really hope that we can find some better ways to incentivize the free market, incentivize banks and credit unions to address this important issue. I'm really hopeful we can find some policies there. You mentioned a lot of the biggest concerns I have. I mean, has Big Brother written all over it. Would the FBI need a search warrant? Would the IRS be able to track what you put into your bank account and then say, well, how are you depositing all of this money every week? You're not paying taxes. You don't have a job. So many problems with privacy, not to mention data breaches, cybersecurity. The federal government is terrible at it. And to think that we're going to put millions and millions of consumers' records into the federal government's hands, it's just not a good plan. At the very least, we should address cybersecurity before. I do hope that we can address this issue in a meaningful way with good policy, because I do think it is very important. With that, Mr. Chairman, I will yield back. Thank you.
Gentleman yields back. I think I need to defend the post office that actually did provide banking services for about 50 years or more. After there was a failure of the banking system back in the early, like 1908, there was a failure of the banking system. So it has been in existence, and it may be a policy matter for us to decide whether we want to put them back in the banking business or not. But I just, for some of my friends who've said this is the worst idea possible, clearly this has been something that's been on the books for many, many years. With that, I would yield 5 minutes to Mr. Lawson, who is attending from his office and is participating virtually. You are recognized for 5 minutes, sir.
Thank you, Mr. Chairman, and I would like to welcome all the panel to this committee. One of the things I would say, and just getting started, is that I grew up in a rural area about 12 miles from the city, longer, and by the time I was 15 years old, I was able to go in to establish a savings account at a bank without any problems. And most of that would contribute to the fact that either through the 4-H club or the FFA, in attending those programs, where people bought information in, telling you what you really could do, and so you had a great relationship. I would be opposed to the post office going into the banking business because we have so many problems in Florida, even with mail delivery, you know, where people are constantly calling my office about they can't get their mail, what's going on, how the people working, they got to hire people. And I don't know how that option would actually work, but I don't think that we should dwell on that at this time. But my question to the whole panel will be, bank overdraft practices have been a barrier for far too long for low-income families for as long as I can remember. And because I have been involved in the financial area for over 34 years, I see these same kind of problems that are coming up over and over again. According to the CFPB, 80% of the billions lost in overdraft fees this year are drained to families with daily account balance averaged over $350. And so that is pretty low. And my question would be, because a lot of you all have all of the academic information and have been involved in everything else. And I know this is true from a lot of people that I've dealt with in the financial world for many, many years. How then can the credit unions, the community banks come up with a policy that they can help these individuals and at the same time be compensated in some way other than charging high overdraft fees?
May I answer that?
Yeah, the whole panel, anybody who wants to respond.
Sure, I'm happy to start. I'll say that the CDFI credit union that I'm a part of does not charge hidden overdraft fees to our members. We see too many banks and even credit unions relying on these high and hidden fees as profit centers, especially in environments with low interest rates. So it's something that we categorically do not do, and we find other ways to sustain our operations and be profitable on our operations alone. Through my organization, New Economy Project's legal hotline, we also assist hundreds of New Yorkers every year that call our hotline, in many cases with problems that relate to overdraft. And what we see routinely is that many people are charged these fees repeatedly. It adds up to hundreds of dollars or more at the end of a month. And when they're not able to repay those exorbitant fees, the banks will actually close their accounts, driving them out of the banking system, and then report those individuals to check systems and other consumer reporting databases that then effectively blacklists those same people from opening accounts elsewhere. So this is one way in which people, it's a massive extraction of wealth from neighborhoods of color, especially from low-income people, and it's also decreasing banking access. It's actively driving people out. So, you know, addressing these consumer reporting databases, these overdraft practices, which the federal government has the authority and the ability to do, would go extremely far. So thank you for that question.
Anyone else like to comment?
So, and it was a very good question. I would also say, if sometimes a small loan could be, even if you look at the APR, it's a better alternative. It might than an overdraft. So if you have more small loans, like say from bank or non-bank lenders, that could be it may not be a super alternative, but that would be a better alternative than having an overdraft. Plus, it wouldn't harm your credit score.
I also just want to say to the representative that the type of accounts that don't have overdraft, that are fundamentally no overdraft accounts, are extremely popular. So whether it's the Bank On certified accounts that have more than 2 million people opening accounts in the last year recorded, or even other products that are out there that don't have it, this is the movement for first-time workers, younger people. These are popular accounts.
With that, Mr. Chairman,
Gentleman's time. Thank you, Mr. Lawson. Gentleman's time has expired. The gentlewoman from New York, Ms. Ocasio-Cortez, is recognized for 5 minutes.
Thank you so much, Chair Perlmutter. And, I think one of the things that's important to acknowledge is that this is one of our first congressional hearings on public banking in modern American history. And today is a historic day. I think it's a day worth celebrating. And I thank the chair for his courage and his political courage and willing to convene this in front of the Financial Services Committee. Now, I learned a while ago, when I first got to Congress, I thought, man, people definitely study what they're talking about here. Then I got here and I realized that a lot of my colleagues don't even read the bills that they are commenting on. But for anyone who is curious, it's right here at the desk. We're making lots of statements that have nothing to do with the legislation. And frankly, if I made comments that very publicly demonstrated that I didn't read the legislation I was discussing, I'd be embarrassed, but that is an aside. Here on planet Earth, though, this bill is about providing a public option for financial services, an option, not a government takeover, right, Mr. Pawar? This is not about a government takeover of all banking services in the United States. But I do think we should talk about how things work now, right? Let's talk about some of the extractive practices of private for-profit banking in this country and why we desperately need a public option. So, Ms. Del Rio, when a commercial bank decides whether to make a loan and what interest rate to charge, it considers not only the riskiness of the loan itself, but it also incorporates the bank's target profit margins based on their quarterly goals and shareholder dividends, correct?
Yes, I would say that the banks are driven by profit maximizing motives, yes.
So it's not this mythology of we have this interest rate based on how risky the loan is, but it's also we have this interest rate based on how much of a profit margin on Wall Street we want to make. Now, isn't it the case that a public bank is likely to be a cheaper option than Wall Street for businesses and governments who seek affordable credit? Because a public bank is non-for-profit, so it doesn't need to pad its interest rates in order to make a profit. Isn't that right?
Right. A public bank would be chartered to serve the public good, and it would remove the profit-seeking shareholders from the equation and allow for other benefits other than maximizing profits.
And a public bank ostensibly wouldn't have, billionaire CEOs that are paid hundreds or thousands times the amount that their lowest employees are made. Is that correct?
Yes, that's certainly our vision for public banking.
Now, in the same vein, public banks are able to extend credit and banking services to communities that Wall Street has deemed unprofitable, correct?
Yes.
Now, I represent parts of the Bronx where more than half of residents are either unbanked or underbanked. We heard some stories today that I thought were very, optimistic and rosy, like Wall Street executives. They will want to compete for business. Of course, they'll extend services in low-income communities. But we're talking about Earth, right? And on planet Earth, there are a lot of communities that are not profitable to bank. Now, how would the Federal Public Banking Act complement state and city level efforts across the country?
Yes, thank you for that question. We talk about the Federal Public Banking Act as a game changer for local efforts like ours in New York, where we are working with broad-based coalitions and more than 65 state legislators to create a state framework for local public banks across New York City. So right now, public banks or cities that would seek to charter public banks would have to go through commercial bank charters. What our legislation locally would do was create an appropriate and safe and sound framework with capitalization requirements and many other provisions to ensure sound governance and safety and soundness.
Thank you. I apologize for cutting you off. I just have 30 seconds left. I'm so sorry. Now, one big thing that people don't know, most public entities at state and municipal levels, they actually are forced to rely, your state, your city bank, the bank that your state and city works with are commercial banks too, right? So a lot of people don't know that your city actually has to keep the city's money with like a Chase or a Bank of America or a Santander, etc., because there's no public bank. And as a result, those private banks can actually refuse to finance projects that are against their financial interest, right? Like they can refuse to finance things like worker cooperatives or renewable energy projects if it cuts against their own profit margin. Isn't that correct?
That is absolutely correct. And that's why we need the Federal Public Banking Act that would provide technical assistance and grants and really be a complement to local and state frameworks like ours in New York.
Thank you.
Gentlelady's time has expired. The gentlelady from Michigan, Ms. Tlaib, is recognized for 5 minutes.
Thank you so much, Mr. Chair, for holding such an incredibly important hearing about, I think, a really critical issue, especially because many of these broken systems and structures that we continue to talk about, these existed prior to the pandemic, and if anything, the pandemic just exposed how broken they are. So I'm so incredibly grateful for my colleague from New York, Representative Ocasio-Cortez, for leading the charge and reintroducing the Public Banking Act this Congress. Chairwoman Waters, thank you. Thank you for always wanting to continue to speak these truths about these broken structures within our country and our communities, especially communities of color. You know, I represent the third poorest congressional district in the country. And so when people say why I do these things, it's because, I move with a sense of urgency. I don't got days or weeks for my residents. They are literally dying because they have no access to thrive. Nearly 20%, a quarter of the US adults are unbanked and underbanked. And one of the most profound ways that this discrepancy has affected my residents is in housing. And this is not just somewhere to sleep, y'all. This is where people use their housing to put their kids through college, to get out of poverty. It's stability. So it is really bizarre. Some of them, maybe not bizarre. Maybe there's a different word when people say too big to fail. We got to bail them out right now. And what a funny thing, too big to fail. How about this? People are too important to fail. People in our country. So when people talk about funding and all this stuff, I keep hearing $700 billion to bail out the big banks. Guess what, y'all? Special Inspector General says that the total was more like 16.8 trillion, 4.6 trillion has already been paid out. The Great Recession that killed neighborhoods in my district was because of big banks. They devastated our local economy. Literally foreclosures at the highest rates we've ever seen, historic unemployment rates, destroyed families in this country. It was the big banks. That's who did it. So when we introduce bold initiatives where we say everyone should be included, we should have accessibility. We should not be judged for trying to do what's right. Because when I look at Michigan, we lost more Black home ownership than anywhere in the country. 2019 home ownership, Black Americans in my community dropped. It dropped to the lowest level, y'all, since fair housing law enacted in 1968. You hear me? That's how low it's gotten. It's close to 40% now. People used to envy Detroit, used to look at Wayne County, Michigan and say, man, how are they able to lift people out of poverty? It was because of housing. So when commercial banks shut out Black and brown people from lending, they're just closing the door on home ownership. They're closing the door on saving for children's education, opportunity to build businesses, ability to retire with dignity. And so it is hard for me to hear my colleagues sometimes judging my residents, because guess what? Majority of my colleagues are millionaires. They're in an income bracket that is so disconnected with the majority of American people in this country. They don't understand what it means to live check by check. I remember the first time I was here, people were wondering, why are the federal employees in the food bank line? What are you talking about? You just shut down government. They live check by check, y'all. Of course they're in the food bank line. They got to feed their children, their families. So Ms. Meriden, I want to talk to you about how would access to public banking help residents in my community move towards homeownership and build wealth?
Thank you for articulating that contrast really well. Access to public banking for residents is exactly what access to public banking for banks would do. It saves them. It throws them a lifeline when they're out of liquidity. This is what we did in the financial crisis. So to people who say, let the private market do it, the private market would have failed. It would have been a completely bankrupt market in 2008, in 2020, again. And the public fisc, the Federal Reserve, along with the Treasury and Congress, came in to save a lot of those public banks, and they asked them politely to please send some of those funds onto individuals, and they had the choice, and they decided not to in some cases. And so this is when we talk about public money going to people, it's the same way that we do with banks. And if banks aren't choosing certain communities to help, as they have not chosen, then we remedy that directly. It's just taking the middleman out. This is not a revision. This is not radical.
No, it's
In
about
fact,
accessibility.
yeah.
It's just period. It's like they don't want all of us to have access. You know, really last thing, and because during the pandemic, you know, one of the things that came up is obviously the Paycheck Protection Program. And guess who screwed my residents? The banks. In my district, smaller Black-owned businesses struggle to pay the PPP program aid they needed because they lack pre-existing relationships with big banks. I had to call Chairwoman Waters a number of times to tell her this bank is doing this bank is doing that. Ms. Del Rio, would public banking make administration of economic stimulus programs like the PPP program or the economic impact payments faster and more efficient for our communities?
Yes, it would. And you can see that in public banks throughout the world, including in North Dakota, which had the highest rate per capita of PPP loans, in part because of what the Bank of North Dakota did to help local lenders get those funds out. And I'll say also that in New York and nationally, CDFI, small lenders, had an outsized role in getting PPP funds out to small businesses. My relatively tiny $85 million CDFI credit union that I serve on the board of, for example, made
Ms.
more than
Del Rio.
$1 billion in PPP.
Gentlelady's time has expired. No other members are here. I want to compliment and thank everybody. This is the best attended hearing this committee has had. I want to thank you all. Obviously, this is a lot of strong passions have been expressed. This is a very serious subject. I want to thank the witnesses for their testimony today. You really helped kind of enlighten all of us on all sides of this. And so I appreciate that. Without objection, a number of letters will be submitted into the record from Prosperity Now, American Bankers, Bank Policy Institute, National Association of Federally Insured Credit Unions, American Financial Services Association, Consumer Bankers, and the Electronic Transaction Association. Where's my closing here? There it is. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to the email address provided to your offices. And with that, thank you very much for participating in this personally and remotely. We appreciate your testimony. And with that, this hearing is adjourned.